is run by a bunch of investment bankers, and their modus operandi.
Look editor for Morningstar in Spain, and today I'm joined by JohnPandtle, the manager of the Nordea One North American All Cap Fund. John, thank you for being here.
Thank you for having me.
John, my first question is about, because we consider your fund as a flexible US equity fund, and I would like to ask you which segment of the market in terms of large cap, mid cap or small cap do you prefer right now, or you see value in the current market?
It's a good question in that we build our portfolio really from a bottom-up fundamental process that begins with identifying a good value. And we do not allocate to market cap from a top-down tactical standpoint. Our idea as an all-cap investors, it gives us the flexibility to go where we're finding the best ideas. But to your question, in the last year and a half, we found more value in large cap and mid cap as opposed to small cap. It's interesting that small cap has underperformed this year, and that's bringing, I think, more opportunities to the table for us perhaps going forward in small cap. But today in our strategy, we're roughly 70% large cap, about 26% mid cap, and roughly 4% or so small cap. And that really compares to historical allocation of about 50 to 70% large, 20 to 40% mid, and about 3 to 15% small. So we're definitely on the upper end of large cap and kind of on the lower end of where we've been on the small cap scale historically.
Okay, to be more practical and to give some investment ideas to our viewers, what sectors would you highlight? And what sector do you really, are you really confident to include in your portfolio?
Yeah, I think the 2 to 3 sectors where we're finding the most value, again, that's where our process begins, would be financials, particularly some of the regional banks in the small and mid cap arena, but also some of the large cap mega banks like a JP Morgan and Citigroup. Mid to small cap banks, they are benefiting from a resurgence in loan growth in the U.S. Businesses and consumers are more confident about the economic outlook and are willing to borrow more money, which I think is a positive comment on the strength of the U.S. economy as well. So that's helping banks increase their growth prospects. In addition, it seems like interest rates have bottomed in the U.S., and to the extent interest rates rise going forward, that should also benefit bank margins. In the last year and a half, we found good value in some of the large cap and information technology companies. These are companies that have transitioned from growth to value stocks. They tend to have very large free cash flow generation. They're returning excess capital to shareholders through good dividends, as well as aggressive share repurchase plans. And they have been very inexpensive until recently. So about a year and a half ago, we got more involved in tech. Names like Microsoft, Apple we bought about a year and a half ago, and Applied Materials is another name that we continue to like.
Okay, John, and to finish the $1 million question, at current level, do you consider that the market is expensive, cheap, or correctly valued?
Well, we're 5.5 years, a little over 5.5 years into this bull market. And in the last year and a half, we get that question a lot. How much further can U.S. stocks go? And it's interesting, if you look at history, what ends bull markets in the U.S., number one is an economic downturn, so a recession. And what drives recessions, at least the last 7, has been an inversion of the Treasury yield curve. So the Federal Reserve pushes short-term rates above long-term rates. And on both of those risk factors, if you will, we think the economy is picking up momentum, is strengthening in the U.S. There's a lot of data to support that outlook, I think. And then the Federal Reserve has made it very clear that they are more worried about deflation as opposed to inflation, particularly with deflationary tendencies very prevalent around the world. So From a valuation standpoint, yeah, some sectors of the market we do think are overvalued. Some of the high dividend yield sectors, utilities where we don't have exposure, telecom, consumer staples, some of the real estate investment trust, as well as some of the major pharmaceutical companies. We're not finding much value there, but in economically sensitive sectors, information technology, industrials, financials, energy, consumer discretionary, we're still finding as much value as we saw, a year and a half ago.
Mm-hmm. Okay, well, perfect, John. Thank you very much for your view on the U.S. market. Thank you very much.
You're welcome. Thank you.
Is run by investment bankers, and their modus operandi